I'm joined by VP Nand Kumar, MD and CEO of Manappuram Finance. Thank you so much for speaking to Bloomberg Mint. Help us understand a little bit about the non-convertible debenture issue and why did you choose this as the time to come up with such an issue, considering the markets have been volatile and there is fear after the IL&FS crisis?
The last 3 years, we have not come out with a public offer of retail NCDs. But we were raising NCDs through private placement. We were placing NCDs in the market to mutual funds, insurance companies and banks. And there was an idea to further increase the concentration of the long-term borrowing in our portfolio. So we thought of coming with a long-term borrowing, in the sense that up to 5 years, 7 years, etc., along with the 3 years product. So we have been thinking about that, and the formalities are completed 2 months back only. In between this fiasco also has come IL&FS. But we didn't deter the launching of issues. We are confident of raising these issues. Why the confidence? Because of 2 reasons. One, we ourselves have a distribution strength. We have a branch network of nearly 3,400 across the country. We have a large customer base which is over 3 million customer base. And we, in the past also, we have distributed these NCDs through our branch network. So one is our own distribution network. The second is the brand equity the company has. The third is these instruments are rated at AA+. We are offering a decent yield of ranging from 9.5% to 10.4%. Because of these, we are very confident even in a difficult situation like this post IL&FS issues. We are confident of easily sailing through.
When we talk about raising more capital, currently 30% of it is through commercial papers for you and only 18% is for non-convertible debentures. Going forward, where do you see that mix standing? Do you wish to cut down on borrowings through commercial paper? Also, what will be, when do you see the next round of capital raise coming?
See, we don't have any worry about CPs more, etc., because our assets matures in a very short period of 60 days. This is the tenure. So the CPs are generally for 2 months, 3 months, etc. As such, we don't have that worry. But still we want to increase the liability mix. We thought of having some long-term borrowings. So with that intent, we are in the market. And we cannot raise, we're coming out with an NCD issues too frequently. But as and when we require, as and when we feel like our ALM is skewed in either of the, to balance that, we may come with a public issue.
What about the liabilities? What is the maturity for your liabilities, at least within 1 year? How many of those are maturing, both in secured and on the unsecured front?
See, first of all, where we should look at is the balancing, the appropriate balancing. When I said 75% of my consolidated book is of short-term maturing, there is no worry. See, the another thing is the tier 1 capital adequacy 25%. Then whether you are borrowing short-term or long-term, it is not material, because asset matures in 75% of asset matures this, and 25% tier 1 capital. Where is the cause of worry? So what is the long-term asset matures in 1 year, etc. It's a question of data only, which has little significance in the business.
Also, when it comes to the cost of funds, how do you see it increasing, considering there is a scare in the market after the IL&FS crisis and NBFCs are struggling with raised borrowing costs?
So we internally expect the pricing to go up by 50 basis points. We believe that the hit will be low for us. The reason is, when we borrow from the CP market, we are able to showcase our strength. We don't face any problem in timely repay. So we have the strength of negotiation there. And banks also, they want to know any lender looks at the ALM. So when the lenders are ready, we don't worry too much about the price going up. So that's why internally we take a call. Maybe there could be some jump of some 50 basis points over a period of time before cooling it down.